Singapore's foreign reserves is one of the world's largest as a percentage of their GDP. In fact, they're the third highest according to Singapore's official sovereign wealth fund website GIC. However, recently we've seen Singapore's foreign reserves go down. Since the COVID-19 pandemic, the government had no choice but to pull money out of this reserve. Why? Well, that's because the pandemic exerted a tremendous economic strain globally, and Singapore was no exception. The government needed to stabilize the economy and support both businesses and individuals during this period of unprecedented challenge. The outbreak of COVID-19 led to significant disruptions in economic activities, causing a sharp contraction in Singapore's GDP. To combat this, the government implemented various fiscal stimulus measures aimed at providing immediate relief to those affected by the pandemic. One of the key strategies was to draw on the nation's substantial foreign reserves. These reserves, accumulated over years of prudent fiscal management, offered a crucial financial buffer. By tapping into these reserves, the Singaporean government could fund extensive support programs without incurring excessive debt or compromising the country's long-term financial stability. But then again, how much foreign reserves does Singapore really have? And how much did they get from their reserves to help the economy get back on its feet? These are the Monetary Authority of Singapore, or MAS, GIC Private Limited, and Temasek Holdings. MAS is the central bank of Singapore and primarily focuses on ensuring monetary stability. It holds reserves as part of its monetary policy and to uphold confidence in Singapore's exchange rate-centered monetary system. On the other hand, GIC Private Limited, which was established in 1981, manages a significant portion of the government's foreign reserves, with its primary objective being long-term investment returns to preserve and enhance the international purchasing power of the reserves. Temasek Holdings, founded in 1974, operates more as a holding company, owning and managing a portfolio of assets, and its activities contribute to the overall reserves, but are somewhat different from typical reserve management. Before we answer how much they have, let's first discuss what a foreign reserve is. Where does Singapore get it? Foreign reserves are assets held by a country's central bank or monetary authority, usually in various currencies, and are used to back liabilities and influence monetary policy. These assets can include different types of money, bonds, treasury bills, golds, and other financial instruments. They're essential for a country to meet its international financial obligations, including the import of goods, services, and repaying external debt. Foreign reserves also serve as a tool for central banks to ensure stability in their own currency, by intervening in foreign exchange markets if necessary. Singapore's foreign reserves are accumulated through various means, such as trade surpluses and the acquisition of the US dollar. The first is trade surpluses. Singapore is known for its robust export industry. Singapore exports more than it imports, meaning they have a net inflow of foreign currencies. The trade surplus has continuously been positive from 2019 to 2023. For instance, in 2023, Singapore exported a total of $638 billion and only imported $567 billion. Another source of foreign reserves is through the acquisition of US dollars in exchange for Singaporean dollars. This action is aimed at controlling the strengthening of the Singapore dollar's exchange rate. Since the early 1980s, MAS's monetary policy has been focused on maintaining the exchange rate within a specific target band. The pressure to appreciate the Singapore dollar stems from both supply and demand dynamics in fund flows. The two primary factors influencing this are public sector operations, which reduce the supply of Singapore dollars. This happens when the government has overall surpluses, and through government borrowings via the insurance of Singapore government securities, or SGS, in the bond market, and special Singapore government securities, or SSGS, to the CPF board. The funds raised through SGS and SSGS cannot be used in the government's budget, leading to a buildup of public sector surplus funds, which are then deposited with MAS. These operations collectively withdraw Singapore dollar liquidity from the domestic banking system, creating upward pressure on the currency's value. Capital inflows into Singapore, which heightens the demand for Singapore dollars. These inflows are a reflection of Singapore's robust economic and financial health, as indicated by its long-standing AAA credit rating. These inflows also contribute to the appreciation of the Singapore dollar. MAS's monetary policy activities ensure that these sources of appreciation pressure do not interfere with the goals of its exchange rate-focused monetary policy or with the domestic money market conditions. When MAS intervenes in the foreign exchange market by purchasing US dollars and selling Singapore dollars, it results in an increase in OFR. From the 1980s to the 2000s, both the discussed supply and demand factors played significant roles in the appreciation of the Singapore dollar and the growth of OFR. Around 25 years ago, the government consistently ran large surpluses, and alongside SGS and SSGS issuances, this led to a considerable reduction in Singapore dollar liquidity. Now, let's dive into the data and see. MAS holds about 480 billion Singapore dollars in total reserves as of February 2024. Before COVID-19, Singapore had about $376 billion in foreign reserves for December of 2019. However, unlike what most people think, the reserves by MAS actually shot up. It went to as high as $579 billion in February 2022. After that, however, it went down by about $383 billion in January 2023, then hovered around where it is today. The reason for its fall is varied. There are new reports, for instance, on April 7, 2022, where Reuters reported that Singapore's central bank, which is MAS, had transferred $75 billion of excess foreign reserves to the government through a subscription of Reserves Management Government Securities, or RMGS for short. RMGS serves as a system that enables the movement of official foreign reserves, which is surplus to the requirements for maintaining monetary policy and financial stability, from the central bank to the government. This allows for its extended term investment by GIC, the Sovereign Wealth Fund. The second source is GIC. However, GIC does not publicly list their reserves. According to its official website and annual report, they have about 100 billion US dollars or 137 billion Singaporean dollars invested overseas. That, however, may not mean that is their total assets in their account. A separate data by Global SWF said that they have 769 billion US dollars, but for official purposes can just draw upon the 134 billion dollars. Finally, before we end the video, it's important for Singaporeans to understand what these reserves mean for Singapore's economy. Let's take an example, the recent COVID-19 pandemic. When the pandemic struck, economies around the world experienced severe contractions, and governments had to deploy significant financial resources to mitigate the impacts. For Singapore, the reserves acted as a vital economic safety net. The government was able to draw on these reserves to fund a variety of relief measures, including subsidies for businesses to prevent layoffs, support for individuals who lost their jobs, and investments in public health to manage the crisis. A key example occurred in early 2020 when Singapore had drawn over $31 billion from its reserve to fund a package of measures to cushion the people and economy from the effects of the pandemic. The ability to utilize these reserves without incurring additional debt allowed Singapore to maintain economic stability and provide a buffer against the unprecedented shock. This allowed Singapore to stabilize the economy and support the population when necessary. The same scenario will be seen in the future at times of trouble, and is also seen throughout the world. But anyway, do let us know what you think. Thanks for watching.